Global growth is still solid, maybe even showing some signs of a pickup. We're beginning to see some evidence of a shift in policy thinking. Of course, in the last 5 or 6 years, there's been a high dependency on monetary policy. There's some sense that's beginning to reach its limits, and so now there's a lot more talk of fiscal policy support, that's taxes and spending, if necessary. Of course, in the US, this really doesn't look necessary. The economy there is fine, and they're talking about when to raise interest rates again. We think probably December is the best candidate for the next rate hike. But outside the US, I think this policy flexibility is very welcome in terms of guarding against downside risks. Of course, it would be better if they're also talking about structural reforms to raise the potential growth rate of the economy. But you'd have to say not too much is really happening on that front. So I think we're stuck still in this moderate growth environment, 3.5%, nothing too worrying, but similarly nothing particularly to be that enthusiastic about, and it looks like that will continue for the next couple of years.
The last month has been more of the same. Range-bound markets driven by shorter-term news flow, investor cash flow and momentum. Underlying fundamentals are not playing a huge role and have been quite stable anyway. Nonetheless, some changes have been effected in portfolios. A careful assessment of the impact of Brexit on the wider market and Europe in particular has led us to believe that the immediate impact is less than expected in the first instance. These effects have moderated, as have fears of the overall impact on the broader European market. For that reason, the decision was made to reduce the underweight to European equity in favor of moving modestly underweight US, Japan and Europe. Asia ex-Japan is the favored equity region and remains neutral in the overall allocation. Within the equity allocation, we have decided to add some exposure to US healthcare on the basis that it looks to have been oversold on concerns of a regulatory impact on revenues. Our view is that these concerns are overdone and that the relative underperformance of the sector provided an opportunity to add. In addition, it plays to the overall theme of adding defensive qualities to portfolios. In conclusion, therefore, we reiterate our stance of moderate risk in portfolios with a focus on yield and more defensive qualities. There is still enough potential event risk in markets to warrant a stance between now and the end of the year, both in terms of politics as well as interest rates and valuation concerns in the equity markets.